Let's turn now to Lindsey Piegza for more analysis on the Fed, the economy, and the markets. She's chief economist at Sterne Agee. So, Lindsey, it seems like the Fed's message really didn't change. They just confirmed what they said before, that interest rates are going to go up gradually. Is that your take on it?
That's exactly right. The minutes reminded the market that it is the statement and not the famed dot plot that conveys monetary policy intentions. And the statement was very clear, very dovish, reaffirming the Fed's commitment to this very accommodative stance. And so the meeting minutes simply reaffirmed that dovish stance and reaffirmed to the market the Fed's intentions in terms of monetary policy.
So how do I take this statement today, these minutes, and apply them in my investing life?
Well, I think the market's reaction tells all. The market liked the idea that the Fed's the Fed's commitment to accommodation was reaffirmed. And again, what this says is that when we look at the monetary policy stance of the Fed against the backdrop of very weak labor conditions, very minimal income growth, despite the fact that the market seems ready and almost wanting rates to rise, it's more likely that the Fed remains at this accommodative stance longer than expected, meaning that the Fed could be on hold well into 2016, possibly even 2017, if we continue to see this very tepid pace of growth.
Mm-hmm. Lindsey, investors are always looking for some kind of headline to let them know that they're on track with their investments. I mean, what's the key thing that they should be looking out for? Is it something about the job market? Is it just overall the economy, housing? I mean, what are you monitoring?
It all comes down to jobs. And I think the Fed's adjustment to forward guidance really highlights how important recovery in the labor market is in terms of not only investment, but in terms of the Fed's guidance for monetary policy. And moving away from just looking at the unemployment rate, the Fed said, look, we have to keep an eye on average hourly earnings, which are flat at 1.9%, the average work week, which hasn't seen any upward pressure, the participation rate, which remains at a 3-decade low. All of these factors contribute to the broader health of the labor market, which gives us a very different, much more dire picture than does that civilian unemployment rate that's come down from a peak of 10%.
So, Lindsey, for those of us who love to get in touch with our inner Fed wonk, what, if anything, should we draw from the unusual video conference meeting that Chair Yellen called in advance of the main meeting? Does it signal anything about her tenure, her leadership, how she's going to do things, what she's concerned about?
I don't know if we can really draw a conclusion from that. Remember, there was a lot of confusion after the March meeting, and I don't think Yellen or any individual member can be blamed for that. I think instead this points to the idea that the economy really is at a precipice. We've had very accommodative policy for an incredibly long time, and yet the economy continues to just bounce along. And so I think what the chairman's intention is to say, look, we're sending a very unclear signal. The market needs now more than ever guidance from the Fed. And I think in the backdrop of the confusion that came after the March meeting, she simply wanted everyone on the same page to make sure that a unified message was conveyed to the market, that message being a very dovish message.
All right, Lindsey, thanks for translating it all for us. We really appreciate it. Lindsey Piegza from Sterne Agee.